We are going to talk about order block, which is also known as sponsored candle, institutional candle. Yeah, so that SCOB or IC. But theoretically, it's order block. So I'm going to be making use of the term order block more often. So yeah, okay. So first, let me make an illustration. I promise this particular video should be very, very short. Yeah, very quick video. Okay, so a bullish order block is the last bearish candlestick in a downtrend or a swing low. So let's make this a red one here. Okay, so assuming we have something like this. Okay, okay. Trying to make sure this is looking nice. All right, so yep. So let's say we have something like this in a downtrend or a swing low, right? In a downtrend or a swing low. So let's say we have this. Okay, so next, which is a green, that's a bullish candle. Now, I said a bullish order block is the last bearish candlestick in a downtrend or a swing low. So take for example, this was a downtrend or this is a swing low, and then we have something like this. Now, usually it is going to be an engulfing candle. For those of us that don't um sorry guys, excuse me. So for those of us that are coming from the retail world, so we know about a little bit about candlestick patterns. So yeah, bullish engulfing candlestick is just this, which we have first a small bearish candlestick and then second a big bullish candlestick fully covering the bearish candlestick, right? So that's a bullish engulfing candlestick. Now, but here we're talking about order block. So I said an order block is the last bearish candlestick in a downtrend or a swing low. So it's also known as sell to buy candle, because this is a bearish candle, so it's a sell candle, right? And then this is a bullish candle, so it's a buy candle. So it's sell to buy candlestick, right? So this particular bearish candlestick, this last one here, this one, this small one here, this is the order block, or this is the sponsored candle or the institutional candlestick, right? So usually we are going to you're going to draw a rectangle. You're going to put up a rectangle. You're going to put up a rectangle, so somewhat like this. Okay, so highlighting this order block, or you could possibly use this horizontal ray. You just put an horizontal line there. So at the open and at the beginning and the ending of the sponsored candle, which is this one. Now, this is going to be your point of interest, your POI, your area of interest. This is going to be your point of interest. This is going to be where you'll be looking to enter the market. So no, not to worry. We are going to talk about Fibonacci. When we talk about Fibonacci, I'm going to emphasize more on area of interest, how to get area of interest, apart from knowing that your order block is what you are fully interested in, right? So but how to really get where to find the right order block, I'm still going to give you more tips on that. So yeah, so for the bearish, for the bullish order block, this is how it looks like. So let's say for example we have the market now going up, we have price now going up, right? So let's assume, so usually it's not going to be as clean as this though, but let's assume this is the case, right? And then we have this. Okay, so let's just put it this way. So let's say we have this. So okay, so now here's it. So if we were having this kind of trend, we're having this kind of a trend. Okay, so I mean, yeah, so like this. So if we're having the swing low, swing high, and then another swing low here. So here's the last swing low. So let's say, okay, I really want this to, I really do not want to take much time doing this. So okay, so let's assume this is what we've seen. Okay, so let's assume this is what we're seeing. So an impulsive movement down, the swing high, that's the pullback, and then another impulsive movement down, right? Breaking this low. So leaving us to this area as our swing low. So you mark your other block, your bullish order block, which is this one. Now the price has broken this previous valid lower high, because this lower high is valid because yeah, it broke this lower low, right? So the SC price has broke this one, right? So we now have this range. Now have this range. Remember when price did this movement, we'll be having a range from here to here. So now price has broken through this range. So now we now have this this other block now ranging from here to this new high here. So obviously your entry is going to be, you're going to enter using this other block. So you're going to enter either from the open of the other block, making use of the other block, like the open of the candlestick, the bearish candlestick, putting your stop loss just below this other block. So you can make it few pips below the other block, and then your target, you can target anywhere above, right? So here's the first type of entry. Either you enter yeah, we're still going to talk more about entries, but let me let you know that for now. So either you enter from the open of the other block, or you enter 50% of the other block, 50% of the other block. So you could just take your Fibonacci, measure the distance between the open and the close of the other block. That's the bullish order block. So if I do that, I'm going to have the 50% is going to be the 0.5 level, which is just right here. Okay, so I'm going to have that level to be my 50%. So I should turn this particular one to, okay, this, right? So now first type of entry is it's either you enter from the open of the other block, or you make use of the 50% of the other block, making it as your entry, and then putting your stop loss just below, and then targeting this. Now the essence of you wanting to enter using the 50% level of the other block is because you're trying to make sure your stop loss is small, right? You're trying to get a better risk to reward, right? Now if you notice, the first entry we are having more like 168 pips stop loss, but this is not the case. Usually you can't have any trade that would even have a stop loss of up to 50 pips or so, but this is just a rough sample. Right now, you either, now look at this. Let's say for example this stop loss is bigger than this one. This one is 95 pips stop loss. So obviously you would want to make use of the 50%. But one thing there is this: when the price is coming down to mitigate this other block, when the price, remember when you watch the first video that says understanding smart money concept, so you understand why the institutions would first had to, like, sell and then buy and go before coming back again, because obviously the institution, they sold from here impulsively down to this, they sold impulsively down to this area, and they did not they did not close their initial sell order, right? They took another buy and then up to the side, right here they're opening another sell, planning to come back to mitigate. That means close their first sell order, this particular one, right? To close their sell order here where they started the buy, so that to mitigate their loss, right? So if at all they are at loss, or but usually they are going to come down and close in profit because they have obviously started the sell from somewhere around here. So if they come back to close here, or yeah, they will close in profit or maybe break even, whatever. So now you either want to enter from the 50% or maybe from the open of the other block. So usually this is what I'm expecting, or this is what we're expecting. Price should come down, you know, keep coming down to the other block. So sometimes price will react just from the open of the other block and move from there back upward. So I mean, sometimes you're going to have stuff like this. So leaving the first trader who used the open of the other block as his entry in profit, or inside the trade and in profit, and then this other the second trader missing out of this great trade, you get. So that's just like the disadvantage of using the 50% entry, but the advantage of using the 50% entry gives you smaller risk, right, compared to this. But obviously sometimes the market will do this, come down first to almost, let's say, the 50% of the this particular order block, and when they do that, they could possibly just change. So uh okay, so when they do that, they could just you know turn, reverse back, starting to go back up. Now remember, they got to this area, right? So they are going to leave a wick right here. We're going to leave a week right here. So I believe most of us already understands candlesticks. If not, I'm going to make a short video explaining candlesticks, right? But they will create a wick right here, a shadow right here. Now this tells you that at some point in time, price was actually around here. Now if they do this, they've activated trader 1 and trader 2, right? Now if they keep going higher, right? So you see the both traders are going to be in massive profit. The both traders are going to be in profit, right? So if they keep doing that, but obviously other blocks can be violated as well. So that means you could possibly use a nice clean order block and still miss out of the of the trade as well. You get. So yeah, that is that for the bullish order block. And then because of time, I'm going to make invert scale so I could explain the bearish order block. So a bearish order block is the last bullish candlestick in an uptrend or a swing high. So I'll have to change this to color green. I have to change this most to color green so as to make it easier for you guys to follow up. Okay, and I have to change this other one to red. Okay, okay, so right here we have sorry guys, please help me with the door. So yeah, sorry about that guys. Okay, so I have to change this one to green as well. Okay, so as to make everything easier for you to comprehend, and then this back to red. Okay, so seeing this now, you understand it's just the same thing I explained earlier, but just the reverse. Okay, so now a bearish order block is the last bullish candlestick in an uptrend or a swing high. So this was an uptrend, right? So they made the swing high here, made the swing low, and then a new swing high. So this was the last bullish candlestick here on the swing high before they came down and they broke this structure, right? Because here we know we have a valid higher low because it broke this higher high here, for example, right? And then this is a higher high which brought later gave us this broken structure from it because this higher low was broken, right? Now our other block is going to be this last bullish candlestick here, right? Remember the other block, I'm going to tell you the criteria as well. Sorry. So I'm going to tell you the criteria as well so that you know what to look out for when looking for other blocks, right? So now the other block is this one, and then price traded away from the other block and later came back to it. So you either would have used or you could use the open of the other block, which is this bullish candlestick here, the last bullish candlestick in this uptrend or the swing high. So you could use the open of the other block or 50% of it. So any of the kind of entries, sorry for that call as well, so any of the entries would make sense, right? So the 50%, the essence of the 50% gives you a lower risk, right? And then the 100, the using the open for your entry, just make sure you enter, you don't miss out from the trade. So if you're always using the 50%, sometimes you would miss your trades, right? But if you're making use of this, if you're making use of this um if you're making use of this 50 this 100%, so you always would get into the trade if the other block is to be respected, right? Okay, so that is that for other block. Now one of the criteria, we have just three criteria. I'm going to uh, write it out. Okay, trying to write it out. So number one is number one is um price will move far from the other block. Okay, let me just make use of OB to make this really short. Then another is uh OB must break structure. That means the other block must break structure. So whether a bullish order block or a bearish order block, after creating the other block, they must break structure. Okay, so another one is okay. So another one is yeah, the other block should be engulfed. Okay, OB should be engulfed. Okay, so please. So the OB should be engulfed, and then maybe yeah. So I feel these three. If you're looking at for these three, should be okay. Now, if you look at this, these criterias are here, right? First, you get this particular OB was engulfed by the second candlestick. So we have number one. Then number two, this OB broke this structure. So the OB made this break of structure, right? Yeah, that should change the trend, right? And then the third one price moved far from the OB. You see how impulsively the price sold down far from the OB. So this is a high probability order block for us, right? So sometimes there might not be liquidity above the other block, but I'm not really going to add that. So when I see sometimes there might not be liquidity above the other block, I mean sometimes you're going to see after seeing an order block like this, an order block like this, right? So sometimes you see that the candlestick which is engulfing the order block has a little wick above that clears liquidity above the other block. So sometimes you see something like this. So this is still, one of the criteria to look out for, but I'm not going to include that, so probably we could talk about that on a live session or whatever, but I'm not really going to include that because it's not really important. So to me, right? So whatever works for you, though, but to me it's not really important. So what I look out for is just trying to look for uh trying to look for this this criteria, right? Yeah. So this is the end of this particular video. Okay, so sorry guys. So this is the end of this particular video. I'm going to make a really short video next to show you other blocks on the live chat and samples of how they work. All right, so I'll see you guys.